There is no doubt we anticipate significant natural gas demand growth, as I said previously, and I think the US in particular is poised to take advantage of this.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? And welcome back to another episode of Wealth Strategy Secrets of the Ultra Wealthy. Today, we're diving into one of the most critical yet often misunderstood sectors for investors, energy. From oil and gas to infrastructure and power, this space is not only foundational to our economy, but it also is facing massive shifts as global demand surges and technology like AI drives unprecedented energy needs. I'm joined by Ben West, co-founder of Pragma Energy, who has spent nearly a decade working at the intersection of capital markets and energy operators worldwide. Ben has a unique 360-degree perspective on the sector, having worked closely with C-suite leaders, family offices, and institutional investors across Europe, Latin America, North America, and Asia. Today, he's going to help us unpack where the real opportunities and risks lie for investors looking at energy, why infrastructure is a critical piece of the puzzle, and how to think about building a thesis in this misunderstood but vital asset class. If you've ever wondered how to access the sector, what role oil and gas and renewables will play in the years ahead, and how energy investing can deliver the trifecta of returns with cash flow, tax advantages, and upside appreciation, this is a conversation you won't want to miss. Ben, welcome to the show.
Dave, thanks for having me on. It's good to speak with you again.
Yeah, absolutely, Ben. Always good to connect, and I think this is going to be really insightful for our audience to really help them get a better sense as investors into the energy sector, the different areas that are, promising looking, right, in terms of energy, in terms of, not only, production around oil and gas and, what's upstream, but also, from the infrastructure side, right, which you represent as well. And so people can really help kind of hone in on their thesis and really talk about why this is such a good sector as we've known for many years now. So before we begin, why don't you help the audience kind of tell us a little bit about your origin story, how you really got into, the energy sector and where you are today?
Yeah, no, absolutely. Thanks, Dave. And I've been in the energy sector coming on close to a decade now. I didn't necessarily actively pursue the energy sector. I think the energy sector really found me. But I was in a previous life was living in Barcelona. I worked for the British Chamber of Commerce in Spain that was focused on facilitating bilateral investment between the British and the Spanish economies. And I felt at the time that I wanted to move back to London. I was looking for opportunities in London and came across an organization called the Energy Council, which really, it was a Blackstone-backed organization. It specialized in brokering relationships between financiers and investors and energy companies from across the value chain. It did that by doing a series of C-suite executive conferences and more tailored and bespoke engagements. And really, I loved my time there. I got to work across European markets, Latin American markets. I worked out of the group's Singaporean office before COVID, and then moved on to the North America portfolio, where I had the opportunity to lead up the North American portfolio for 4 years, and also had the opportunity to launch the group's investor engagement efforts globally. So that's I guess it wasn't necessarily an active move, but really a result of me having wanted to look to come back to London. And I was very fortunate to meet some good people and have some good conversations, which led to that role. And I mean, we as I said, I loved my time at that organization, had the opportunity to connect with and meet with C-suite executives, both at operators across the oil and gas value chain and across the energy transition value chain, as that became more prominent and more of a focus for a number of the stakeholders that we were speaking with, as well as capital providers and investment managers really across the capital stack, from large institutional allocators all the way down to single family offices. So it was a really rich and rewarding 7 or so years that I was with Energy Council, and now coming on a year ago, it will be a year next week actually, moved away and launched Pragma with 2 former colleagues, Amy Miller, and who's Pragma's current CEO, and Jack Ingram, who's our Chief Commercial Officer. So it was that's sort of my journey so far in the energy industry. It's definitely been an exciting one, an eye-opening one, and definitely caught the bug and here for the long term.
Yeah, no, I think the last time we connected was at the NASDAQ in the last year's event that the Energy Council held, and really what a phenomenal event that it was. Hosting some of the top thought leaders and operators right in the space, and really understanding where some of the opportunities are, where some of the risks lie. Across the entire sector and value chain, as you pointed out. So you've had such a great opportunity to see a 360-degree view inside, right, of the industry and kind of thing. So interested to hear a little bit of what you're doing at Pragma and on the infrastructure side. But before we jump into that, I think it's really helpful to help investors really understand kind of the energy ecosystem as a whole. Maybe we can start at that 30,000 foot level and really kind of break it down, because many people have actually never invested. It's actually a lot harder, I think, to invest into the energy sector as an accredited investor. Some people, we talk about the amazing tax benefits they have to offset, tax, active income. But why don't you talk just really, again, kind of, high level about the sector from your perspective, and then maybe we can drill into some, kind of opportunity areas.
Absolutely. And I'm happy to go into that. And I think, alluding to your point, a lot of conversations that we have had with family offices and more generalist investors are around the challenges that they face when it comes to not necessarily having deep energy investing expertise, or a team that has a track record or in-house capabilities to be able to evaluate a lot of the different technical risks that come with energy sector investing, whether that's subsurface, whether it's geopolitical, whether it's commodity price risk. So it's definitely they're definitely all themes that come up in conversations that we have with different groups that we engage with. But I think in terms of Pragma and our view on energy, we launched the business a year ago now because I think that our belief was that the oil and gas industry had been vilified. It didn't receive due credit for the good work it does in providing reliable, affordable, secure energy to the world today, and didn't receive due recognition for the ability it had to leverage its balance sheets, the workforces that it has at its disposal, and the capabilities it has within those workforces, and the experience that it has of rolling out wide-scale commercial projects and applying these to longer-term decarbonization goals and initiatives. I think we've definitely seen a shift in sentiment towards the oil and gas and the fossil fuel industry since the new administration, the Trump administration, has come into office earlier this year. But prior to that, the narrative had become, and I think still is to a large degree, it certainly is here in Europe where I sit, very polarized into no more fossil fuels. And I think that's the first sort of hurdle where groups, whether it's policymakers, whether it's investors, capital providers, sort of public groups and campaigning groups more broadly fall down at. I think the biggest misconception that people have is the sheer scale and volume of energy that's required in this world. I mean, I'm happy to go into detail and provide a few stats and touch points to provide some context there. But I think the sheer scale of energy that's required is something that's not widely, I think, understood. And so really what we're doing at Pragma is looking to provide a platform, build a platform where we bring multiple stakeholders together to facilitate a pragmatic, holistic conversation about the need for reinvestment into the sector. The sector needs more capital now than it's ever needed before if it's to meet the ever-growing energy demand that's anticipated, whether that's from AI and data centers that are being developed across North America, or whether it's through growth of developing markets, developing economies, whether that's India, China, Southeast Asia, Africa. There's going to be a vast quantity of energy that's needed, and I don't think the conversation should be a case of either or. The fact is we need all forms of energy feeding into the system to meet this growing energy demand. I think when we look at and again, I think when we look at the opportunity within the energy industry, if I can just provide a couple of sort of observations from conversations that we've had over the past couple of years of engaging with C-suite execs, whether it's at an operator level or across the finance and investment landscape, the traditional energy sector has experienced an unprecedented outflow of capital in recent years. In 2014, we saw about $60 billion worth of capital raised for traditional energy funds. Fast forward to 2022, that figure had dropped to about 2 or 3 billion. So that's record lows for the space. And I think there were some really obvious and key drivers behind this flight of capital that included whether it's poor performance from the industry, ill discipline from management teams, ESG headwinds. A lot of investors had been burned, and I think the industry was widely perceived as being a poor steward of generalist capital. And subsequently, a lot of LP dollars, a lot of generous capital left the space. A lot of LP dollars transitioned over to various energy transition funds, which we considered to be a mispricing of risk. We don't yet, in many cases, have commercial hydrogen. We don't have large-scale nuclear, and a lot of nuclear is a hot spot at the moment. It's definitely a theme and a subject that's dominating a lot of conversations, but these are projects which have long lead times. They've got a lot of regulatory and policy constraints and bottlenecks that need to be overcome, and that's perhaps an asset class or an investment opportunity which many investors aren't yet comfortable with or aren't willing to see out the long lead times that they'd be required to wait to see a return on the capital invested. And so there's a lot of these types of opportunities, recycling opportunities, which aren't yet proven at scale. And therefore, I think from our perspective, the danger was that a lot of these LP dollars were getting invested in assets that aren't supposed to have private equity money invested in them and aren't yet ready for private equity assets. I think, and that was prominent during the sort of COVID period and as we came out of COVID, I think a lot of investors found it very easy to point at poor performance and just say that they wouldn't invest in energy because of ESG. But I think the reality is that the tone and the narrative behind that conversation is shifting and will continue to shift moving forward. I think over the past 12 to 18 months or so, we've definitely seen sort of various funds having gone out and raised. There has been an uptick in terms of capital availability to the sector. There are a lot more positive conversations taking place as it relates to fossil fuels and oil and gas. And I think part of the reason for this is that the industry has become much more disciplined. Debt is down substantially on what it used to be, and distributions are much higher than they used to be. However, as I mentioned earlier, the number of funds that are still active in the space are fewer than they used to be, and the size of the funds that these groups are raising are smaller than historical averages. And so I think we believe this. I mean, really, the fact that the industry, the amount of capital that the industry requires now, the opportunity we see through sort of energy demand forecasts and growth forecasts, again, both domestically within North America or on the international scene, it presents a really exciting and compelling opportunity for capital allocators that are willing to lean into the space. Appreciate I've said a lot, so I'm happy to pause there.
No, I think that's great context, Ben, for sure. And I think really probably one of the biggest headwinds, right, that we had was the pandemic, right, when pricing basically went negative and it had pretty much the whole industry seized up. And, I think what people need to realize is, and, maybe you can unpack this as well, is, from an infrastructure perspective, I mean, it takes years and years to put infrastructure in place before you actually have production, right, that you can produce. So when the industry, like, we had that seizure, right, it halted production, right, for a number of years. And then also with these other headwinds and everything, there just hasn't been, capital inflows, right, into the sector. But we need that lead time, right, to create the infrastructure before we get to production. And also, I think a big driver that's maybe changing some of the narrative right now is AI, right, and that demand for energy. And lastly, I think you said it really well, but I'd like to emphasize this point is that it's not one or the other. We need all forms of energy, regardless of what industry you're in, where you live in the world. Right, the demand for energy is just completely outpacing availability, and these are fundamentals we look for as investors.
Yeah, absolutely, and there's a huge amount to unpack there, and there's a lot of different, I guess, infrastructure investment opportunities that present themselves as a result of the bottlenecks that you alluded to. I think if I start with AI, which you alluded to, again, AI is viewed as a transformative force. It's already dwarfing fintech, dwarfing industrials in scale. I think, to put it in context, generative AI is 2.5 times larger than fintech and industrials. And just to put some stats behind sort of the power demand growth that we're anticipating to see, growth of generative AI will require around about, give or take, 200 terawatt hours of additional power over the next 5 years. In layman's terms, US power demand is expected to triple by the end of this decade. So I think it just shows the scale of the challenge that we're facing, but also the scale of the opportunity for those that are willing to lean into the space and start to fund the space. I think it's the key challenge has definitely been around permitting issues. I think under the previous administration, there was a lot of red tape and a lot of, as you say, a lot of uncertainty for investors wanting to invest in those types of opportunities, about the lead times, how long. There were a lot of concerns around project delays, obviously rising costs that are associated with that, and when capital providers would be able to see a return, firstly see that capital return to them, and then see a return on the investment that they're providing. I think the other opportunity that we see, sort of outside of that AI and power space, is gas. It's an incredibly compelling investment opportunity for those that are able to wrap their heads around it. I think we're anticipating significant natural gas demand growth. Again, we look at, when I talk about sort of AI and power and the scale of the additional power generation capacity that we're going to need to see, the key question you have to ask is, where is that energy coming from? I think you have a lot of challenges at the moment when looking at renewables, around scale, around intermittency challenges. Obviously, the solar is great when the sun shines, wind's great when the wind blows, but what happens when these resources aren't available 24 hours a day? We don't have the battery storage solutions and technologies at scale, and so there are a lot of challenges in terms of the first priority for the companies that are developing these data centers and these assets are to have 100% reliable, affordable energy 100% of the time. And so really and I think when you look at it, the abundant resource that we have that is able to provide this reliable, affordable energy 100% of the time is natural gas. And I think there's a number of different arguments which you can put forward as to why that's an attractive option, why that's an option that can both, as I say, meet that energy demand in the short term, from a reliability standpoint, but it also has a pretty, I guess, strong argument in terms of the environmental case that it can put forward. And again, I'm happy to go into that, but natural gas has, I think, less than 50% of the carbon intensity of oil. It's a much cleaner fuel than coal. The US has been the most successful nation in the world in terms of reducing its emissions. The way that it's done that is by coal to gas switching. If we look at a lot of these other nations around the world, where India, China, a lot of their, I think 50% of their electricity generation is coming from coal-fired assets at this stage. In time, they're going to look to convert their grid capacity and their utility system to gas as well. So that presents a huge opportunity to reduce emissions from those energy systems as well. So but it's definitely a huge challenge that's going to take a long time to overcome. The reality is the amount of energy we need to bring online. There is no doubt in my mind that the US has those resources at its disposal, but the challenge is getting those resources to the demand centers and the demand hubs that need them. The fact of the matter is, US sort of grid infrastructure hasn't been updated in 40 years, and so therefore doesn't have the capacity to be able to meet the demands of that and additional power generation. And so there are a lot of other opportunities and other I guess innovative solutions that a number of, whether it's the sort of the big seven tech companies, whether it's the infrastructure developers, whether it's energy producers, are looking at to come and overcome those challenges at the end of the day. So there's a lot to unpack, but the reality is we need to vastly upgrade our infrastructure. We need to streamline the permitting process to be able to allow new infrastructure to be brought into development, and we need to provide long-term regulatory certainty and clarity to give capital providers the confidence to come and put capital to work in these type of assets to allow the build out and scaling up of a lot of this infrastructure to essentially get the energy supply to these demand centers.
Yeah, so let's talk about gas a little bit, because I think that is a big opportunity area, right? And for the listeners, what's fascinating, right, is, I think we're trading in the low threes, right, on gas today. But I believe last time I looked, Japan it's actually in the 20s, right? Substantially higher. I know in Europe it's much higher as well, and they are trying to now, move off of this dependency off of Russia, right, to try to figure out, their own resources there. But as you said, we have limitations in terms of the infrastructure that's in place. How do you move LNG around, around the globe? Right, these days, even if we can kind of source it, how can you do that on a cost effective and reliable basis? So any thoughts there in terms of, advances in technologies on the infrastructure side? And, what does the landscape look like for energy, right, on a global basis moving forward?
Yeah, I mean, it's a big question, and there's a lot to unpack. I think there is no doubt we anticipate significant natural gas demand growth, as I said previously, and I think the US in particular is poised to take advantage of this. You alluded to Europe in particular and the position it finds itself in. I mean, again, it had allowed itself to develop this dependency on Russian gas, and obviously the events of the past couple of years have really created this urgency to ease itself and wane itself off this reliance that has developed on Russian gas. I think it's really exposed a lot of the flaws in European energy policy. I think a lot of these governments and jurisdictions across the region had really, I guess, strived to roll out renewable and renewable energy systems. They had really put sort of prioritizing decarbonization of the energy mix ahead of energy reliability. And you're starting, I mean, you mentioned the price indexes that we're seeing across these different regions. That's starting to play out in terms of, you look at the cost of gas in the US, where there's an abundance of the resource, versus some of these other regions, it's night and day. And when you look at the policy and the way that, I mean, I look at the UK in particular, it's where I'm based, the attack that the government has sort of set out to or the way that the government has set out to destroy the oil and gas industry in the North Sea, it's ludicrous when you look at it, because you think about the resource that we have available on our doorstep. This demand doesn't go anywhere anytime soon. This demand still exists. We just end up importing a lot of these resources from other jurisdictions, paying tax revenues to other jurisdictions, UN creating jobs and employment in other jurisdictions, and then you've got the emissions profile that's associated with shipping a lot of these commodities around the world. So I think the point being, and the reason I say that is Europe in particular has allowed itself to, I guess, not have this holistic mindset and approach about the need for all forms of energy as it relates to sourcing that energy to meet its power demand. I think it's outsourcing a lot of its industrial activity. I mean, energy really is a regressive tax on life if it's not cost competitive, and as a result of ill thought through energy policies across the region, we're seeing a lot of the industrial activity be outsourced to other regions which do have competitive energy policies and an abundance of energy access. In terms of the opportunity within gas that we see, I mean, looking at it internationally, as I think I alluded to it earlier, we're anticipating to see expected demand growth will come from developing countries. A lot of that growth, I think I alluded to it earlier today, will primarily come from coal. Over half of China and India's power supply comes from coal. In the Americas and Europe, that's more like 15 to 20%. Over time, we do expect countries like China and India to coal to gas switch. This means a tailwind of demand forecast for US gas. If we look at a couple of stats, US LNG export demand is expected to grow from 11% or roughly 11% of US production to roughly 20% over the next 5 years. Physical capacity to export US natural gas is expected to more than double through 2030 as additional LNG facilities go live. So the moral of the story is the US has this unique opportunity, and I think it's really well positioned in the fact that it's a low cost producer of natural gas. And I think in the context of many other industries across the country, there aren't many industries that can boast at sort of being as competitive as the US natural gas industry is on a global scale, from a cost standpoint. To be able to meet this growing demand and to be able to provide the world with low carbon, reliable, affordable gas as this demand continues to play out.
Hey, it's Dave Wolcott here. Let me ask you something. Are you tired of the same old financial advice that leaves you spinning your wheels? If you're ready to discover the real secrets the ultra wealthy use to build unstoppable wealth, then I've got something just for you. My new book, The Holistic Wealth Strategy, is your ticket to learning the proven strategies that the top 1% don't want you to know. This book isn't just about money. It's about building a life of purpose, freedom, and lasting impact. And I want to give you a free copy. Visit holisticwealthstrategy.com and get yours today. It's time to level up your financial game and create the future you deserve.
Yeah, absolutely. So Ben, if you were an investor today, right, where we are in the cycle and everything going on, where would you be looking to allocate capital? Where are some of the best opportunities people should be looking for?
It's a good question. I think there's an abundance of opportunity. I would say there's two key asset classes that are standing out as opportunities that are generating a lot of interest from the conversations that we're having with different investors across the capital stack. The first is around the oil and gas and minerals space. I think we've seen in the big beautiful bill that's obviously been passed in recent months. Sort of one of the effects of that is subsidies in the renewable space are set to come to an end over the coming sort of 12 to 24 months. And as such, I think the onus has moved on to some of these oil and gas properties, minerals properties, where there is the opportunity for investors. I mean, that's something actually that we've seen a lot of interest from real estate investors in particular, looking to defer capital gains tax, and the opportunity and ability for them to allocate their capital into oil and gas and minerals properties and to continue to reinvest that going forward in order to take advantage of some of those tax benefits and tax opportunity or tax efficiencies and the opportunities to maximize the wealth and the capital that they've been able to generate there, and to continue to have that acting as working capital in some of these assets. I think the other opportunity is around the power space and the opportunities we're seeing across power, as I've alluded to, the sheer scale of the opportunity, the sheer scale of energy demand growth that we're anticipating in that particular sort of asset class or subsector within the energy industry, it's an opportunity that can't be ignored. I think people are understanding just the interconnectivity between the oil and gas industry, the technology industry, and the power industry more broadly, and how all of these are entirely sort of dependent upon one another to be able to meet this ever-growing energy demand. And so I think looking at the infrastructure opportunities across the power space, the opportunity to develop off the grid, off the behind the meter solutions to be able to provide some of the power and the opportunity or to provide the power that's required to drive and operate a lot of these facilities and a lot of these assets is something that can't be ignored. And I think the scale of the opportunity is something that's incredibly exciting for those that are willing to lean into the space. I think I alluded to it earlier, the amount of capital that we've seen leave the energy sector. I've said it before, the sector needs capital today more than it's ever needed in the past, and that's not just across one particular subsector, it's across all subsectors of energy. And so I think the fact of the matter is this industry is an industry that has been starved of capital. It's an industry that has it's an industry that has learned its lessons from the past. It's restructured itself. It's reduced debt. It's improved its governance structures, the management incentives, and as a result has become a much more, I guess, disciplined. It's a much more disciplined industry that is prioritizing, I guess, shareholder objectives and goals over its own goals and desires, if you like. I think there are two different considerations to take into account when looking at opportunities going forward. There are a lot of investors who obviously want to prioritize cash flow and regular distributions on their investments, and I think with those types of opportunities, you're seeing a lot of attractive or sort of high quality teams that you're able to partner with across the minerals and royalties landscape, across the upstream landscape, where a lot of these teams have now bought up and built strong positions of PDP and or producing assets which are able to generate those types of returns and provide regular distributions to investors that are committing to these types of strategies. For those investors that for those investors that have perhaps more patience, more long-term capital, and a bit more risk appetite, there are incredible opportunities of scale, I would say, in both the infrastructure space and the oil and gas sort of development opportunities. I think during COVID and coming out of COVID, where a lot of investors had been burned, these groups were or a lot of generous investors and LPs and shareholders were keen for companies to, as I say, prioritize cash flow and providing returns to investors over growth at all costs. That's still the case, but I think there is a recognition that a lot of these assets, a lot of these basins are maturing, they're declining assets, and therefore a lot of the companies that are operating these assets need to replenish their reserves, replenish their inventories. And so the opportunity to pair PDP cash flowing assets with opportunities that are able to provide development upside are something that's generating quite a bit of interest at the moment. I think something that's also interesting, and maybe I'll wrap it up there, something that's also interesting is a lot of international opportunities. I think there's a lot of capital that's been raised. As I said, a lot of the basins across the lower 48 have been developed. They are in many cases maturing or later in life than perhaps they were 5-10 years ago, and so we're seeing a lot of interest also around other basins that maybe have similar qualities and similar scale elsewhere in the world. It's interesting on a larger scale. We've seen groups like Continental and EOG invest internationally. In Turkey, for example, we're seeing a lot of interest at the moment in the Vaca Muerta in Argentina. So if the Argentinian government's able to get its act together and get the right type of fiscal environment and regulatory regime in place to be able to provide investors the confidence and the certainty to invest over the long term, that's something that could definitely come to the fore. And Australia as well. I think there's a group which I know a lot of Texan-based families have invested in called Tamboran Resources. They're sitting on the Beetaloo Basin, which, speaking to a number of advisors across the sector, is sort of estimated to be an opportunity that shares a similar scale of the Marcellus up in the northeast in the US. So there's a lot of, I think it's early days when we look at these international opportunities, but there are a lot of interesting opportunities of scale for US operators and US energy investors who have developed a lot of experience and a lot of expertise of unconventional shale assets across the US to be able to translate this expertise, this experience to international opportunity sets as well. So that's something that I think we're keeping an eye on as well. So I think there's I think to summarize, that's really key three opportunities. There's PDP assets, minerals and royalties assets across North America, across the lower 48. Sorry, there's the infrastructure assets that are required to take a lot of these resources to market and to the big demand centers and the hubs that exist across North America. And then something that we're keeping a keen eye on. I think it's still early days. There's these international plays as well, and the ability for US companies with a high level of experience and expertise to be able to apply this experience and expertise to some of these opportunities over time, if the right regulatory environments exist for them to be able to enter those markets.
Yeah. No, one of the things that I really love about this sector that supports our investment thesis, outside of strong macroeconomic fundamentals, also non-correlation to the stock market is really key. But in addition to that, something you pointed out there, which is really the flexibility of this asset class to do really three different things from a return profile standpoint as an investor. And so one is to generate consistent cash flow. That is one key factor. The second is taxes. And again, if you're newer to investing in oil and gas, one of the great things about this is you can actually offset your active income. So if you're a high income earner, you've got capital gains taxes, whatever, investing into this sector will provide a very healthy offset in addition to a return. So we have tax efficiency there, number two. And number three, we have this forced appreciation play, right, where we can drive value into these assets, and whether those be infrastructure assets, value add type assets, right, but constantly, growing and scaling, right, that presents upside potential for investors as well. So depending on, what's your priority right there, it really does give a really nice, what we like to call as a trifecta of a return profile, similar to the real estate asset class. Now, Ben, what about from a risk profile standpoint and also a diligence perspective, are there any key things that investors, if they were looking to allocate to the sector, key things you'd recommend people, look out for or start to work through in terms of their due diligence?
Yeah, no, absolutely. And I think that's something that we're really set on trying to help generalist family office groups to unpack. I think the feedback that we've received is energy is a very technical industry. There's a lot of language in there that can be hard to wrap your head around. There's a lot of different considerations. There's a lot of volatility, which takes time to get comfortable with if it's not a sector that you have studied or have a track record in, or don't have a huge of experience in. And so for us, I think we're very focused on bringing different family office groups together to be able to engage in conversation with one another and share notes on what are the types of opportunities that are presenting themselves in the market, what are the right types of vehicles, or I should probably take a step back and say a lot of the families and a lot of the generalist investors that we speak with have fed back to us over the last 12 to 18 months or so that they feel that they are underexposed when it comes to energy. They haven't necessarily taken advantage of a lot of the opportunities or the returns potential that has begun to develop over the past couple of years since we came out of the COVID pandemic, and therefore they're interested in understanding either who are the top quartile management teams, whether that's at an operator level or a GP level, that they can be partnering with to go about increasing their exposure and increasing their allocations to the space, and what are the right types of vehicles, what are the pros and cons of different strategies, whether that's a mineral strategy, an upstream operating strategy, whether it's an infrastructure strategy, a transition strategy. What are the pros and cons of these different strategies, and sort of what are the best or the most suitable vehicles that are aligned with their particular interests to help them to be able to get comfortable with energy investing first and foremost, and that are aligned with their returns expectations. So maybe to come back to your question, and when asking what are the key challenges that are coming up in conversations that we're having with family offices across our network, I think there are a few sort of questions that have consistently come up, and that really is, how can a generalist LP or family office overcome the challenges of underwriting oil and gas deals that often require a full dedicated staff consisting of a technical team, a land team, etc. On a risk-adjusted basis, are returns in the private sector generating enough above public markets to warrant an illiquidity premium? How can family offices focusing on long-term recurring earnings navigate the unpredictable nature of oil and gas markets, which can significantly impact investment timelines and profitability? How can the pooling of expertise and resources lead to more robust project outcomes and shared risks? And I think an interesting trend that we've seen come up in over the last 12 to 18 months in particular is, what are the pros and cons of fund structure versus asset discretion? How might the diligence process for a typical deal in an investment manager differ from the level of diligence in a direct deal? So I think there's a lot to unpack there. But there are a number of the conversations that have been brought up when we've been engaging with families that are interested, and many of the families that we've spoken to don't necessarily have current exposure to energy or vast amounts of exposure to energy, but I think they see the opportunity as a result of many of the macroeconomic trends that we've discussed today, and a lot of the upside potential, and the fact that so much capital has left the sector. But there are a couple of the I guess key considerations that need to be taken into account when evaluating different deals. And honestly, I think from my perspective, and again, we don't provide investment advice. We're not a broker. We don't provide deal advisory. But what we do, I mean, we have, I would say, unprecedented access to top quartile management teams, whether, as I say, at an operator level or at a GP level across industry, who have incredibly impressive and long track records of energy investing, whether it's across oil and gas, whether it's across infrastructure, whether it's across alternative asset classes. And I think it's really important, if these groups are looking to go about allocating to the space, to really take the time to get to know these teams well, to be able to really ask them the challenging questions that you're not comfortable with. I know there's a lot of the GPs and teams that we've spoken with have been able to get a lot of these generalist families comfortable with energy, with allocating to their particular strategies by walking them through hedging strategies and how they're protecting themselves from commodity price volatility, through their different hedging strategies and approaches towards obviously hedging out their production over a set period of time. So and again, it comes down to the individual preference, but it is interesting when looking at that final question of the pros and cons of fund structure versus asset discretion, just seeing how actually a lot of these groups now are wanting to eliminate the layers of fees and the structures that come with investing through a fund, getting more direct exposure to the asset itself, and directly with management teams to be able to get that type of exposure. But again, I think if that's an approach that a family office is going to take, you have to be incredibly confident that the team you're partnering with is top tier, and has the ability to not just identify risks, but highlight what those risks are to you, walk you through the time horizons, walk you through the investment process to get you comfortable with putting your money to work in these types of opportunities.
Yeah, sage advice for sure. Ben, really want to thank you for your time today, and it's been such a pleasure getting together as always and providing your insights for our audience today. If people would like to connect with you and learn more, what you're doing at Pragma or follow you, what is the best place they can get in touch?
Well, I think we've built out our presence online now. So I think, firstly, please do go and visit our website, www.pragma-energy.com. I'm more than happy for people to reach out to me, either connect with me on LinkedIn or to reach out to me over email. My email is ben.west@pragma-energy.com. And we'd welcome the opportunity to speak with families, whether seasoned veterans in energy or whether newcomers to the space and just interested in connecting with highly experienced teams that can walk them through that process and give them insight into where might be a good place for them to start if they are looking to go about increasing their exposure to the space. We'd welcome that conversation. And I hope to hear from many of your listeners off the back of this conversation.
Excellent. Thanks so much, Ben. Really appreciate it.
Thanks, Dave. Great to speak as always, and look forward to catching up next time we're in Florida.
Yeah.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.